The financial news focuses on tech startups being bought or valued for billions or hundreds of millions of dollars. We are in the midst of another tech boom. But could it be a bubble? Bill Gurley, who backed Snapchat, Uber and Zillow, says venture capitalists have taken on an excessive amount of risk. Wesley Chan, an advisor at Google Ventures, reckons there will be a correction within the next 9 months. And investors seem to be getting fed up with startups burning through cash without robust revenue models. Meanwhile, while getting seed money for a startup remains relatively easy, large-scale venture funding is becoming increasingly hard to secure. So is there a tech bubble? And how can entrepreneurs navigate through the funding process? Welcome to The Big Question, the monthly video series from Capital Ideas at Chicago Booth. I'm Hal Weitzman, and with me to discuss the issue is an expert panel. Scott Meadow has been a clinical professor of entrepreneurship at Chicago Booth since 1999. He teaches entrepreneurial finance and private equity and commercializing innovation, and has been named twice by Businessweek as one of the US's outstanding entrepreneurial professors. He's worked as a general partner with 4 venture capital and private equity firms since 1982, and in 2011 he was awarded the Daly Medal for his services to the venture capital and private equity industries in Illinois. Waverly Deutsch is a clinical professor of entrepreneurship at Chicago Booth. She teaches building the new venture and coaches startups at the Polsky Center for Entrepreneurship and Innovation. Her research focuses on the execution challenges entrepreneurs face as they grow their businesses. She's also an active angel investor. And Ira Weiss is a clinical professor of entrepreneurship and accounting at Chicago Booth, where he teaches advanced MBA courses in tax strategy and entrepreneurship. In the past, he's worked for Ernst & Young and Coopers & Lybrand. He's a founding member of Hyde Park Angels, an angel investing group affiliated with the Polsky Center, and he's a partner at Hyde Park Venture Partners. Panel, welcome to The Big Question. Waverly Deutsch, let me start with you. Paint us a picture. What is the idealized path for a successful startup business?
When we think of the kinds of companies that make news, that are covered in the press, they've probably gone through a path that looks something like this. They had an idea, they used their own savings to fund it, maybe got some friends and family money, got it to a point where they could prove the concept, get a few customers, brought in an angel fund for a round in the hundreds of thousands of dollars, grew the company a little bit till it had revenue and customers, met a venture capital partner who would come in for a couple of $1 million. Maybe there was a Series A, a Series B round, which would be a much larger.
Hang on, so just define those terms. So Series A is roughly how much, or at what stage are we talking?
So they would get an initial round from a venture capital company, typically called a Series A round, somewhere in the $3 to $8 million range.
And so let's just take you back 1 second. So seed funding is roughly how much? What does a startup get with seed money?
So with an angel fund or an angel round, a company would raise several $100,000, $500,000, $750,000, something like that. Then they would go on to work with venture capitalists, build the company, get a Series A round, a first formal round of investing that would be in the range of, say, $3 to $8 million. If the company was successful, continued to get customers, continued to grow, venture capitalists would come to fund higher growth. They call it a Series B growth round, $10 million, $15 million. Sometimes we hear companies getting upwards of $30 million of funding. Continue on as they grow, maybe go public someday, or sell the business to a large company. And that's kind of the prototypical path that entrepreneurs who are in this growth area want to follow.
Okay, so those are kind of the stories that we hear about a lot. The stories we don't hear about a lot are the thousands of companies that maybe go to the first stage and then never make it beyond that. So you've talked about this idea there's a bottleneck. Thousands, tens of thousands of startups get funded at these very early stages, these hundreds of thousands of dollar stages. And then when you come to the Series B or beyond that, relatively few companies get funded. So there's a bottleneck there. Tell us a bit about that, and what does it mean for the industry?
So if we think of startups as simply new companies, in this country, there's over 500,000 people launching new companies every year. Now that includes small mom and pop businesses that aren't going to go on this funding path, But if we look at the number of companies that angel investors are supporting, we see that of those 500,000 companies, in 2011, over 66,000 companies received the kind of backing that I talked about with that seed or angel funding. What that means is we have a lot of companies that are expected to grow, are expected to get return on investment for their angel investors. They're all out looking for that Series A funding. We get a big problem there. In 2011, venture capitalists did under 400 seed deals. If you put seed, Series A, and early stage, they still only did about 2,000 deals in 2011. 66,000 companies get angel funding, only 2,000 of them get venture funding. So how are they going to grow their businesses, right? If there is this dependency on external funding, we've got a lot of companies that have gone through those early proof of concept phases, gotten a few customers that think they're now entitled to several $1 million of Series A venture funding that aren't going to get it.
Right, Ira Weiss, you're on the angel side and in the venture side. So why is there that anomaly? I mean, why should it be that so many companies? It's relatively easy, as we said in the intro, to get that angel money, and then it becomes extremely hard beyond that. Why should it be that so many get the money initially and then so many fall beyond that?
I think it's because of some structural changes that have happened both on the startup side and also on the funding side over the last, say, 5 to 7 years. Many people have talked about how it costs less than $100,000 now to really get a technology company off the ground. And in fact, it can cost even less than that if a founder or co-founder is a technology developer themselves. So what you have is a lot of companies that get started at that phase, and to get from that to starting a company to essentially proof of concept and showing that you have something that works, you can do it inexpensively. And even the next point, now if you think about what do you need to do to get your first customers, the cost of that has gone down drastically because you can market on Google, you can market on Facebook, you can market in all these different ways and show you've got some initial traction. So people get to that initial point much earlier and quicker and at a much lower cost. And then you add in the fact that you now have AngelList and some other crowd sources of funding and also friends and family, and you really have almost a perfect storm at the earliest stages of having many, thousands of companies that get started, tens of thousands at the earliest stages, and have enough external validation that people are willing to write checks at that stage. But then the question is, what happens at that next stage, and can you get venture funding, which is then much more difficult. One of the things you see is many more companies started that are addressing the same problem. So it becomes much more competitive. Even you'll see 10, 20, 30 companies that are going after the same pain point in different ways. And then the venture capitalists, in some ways, can kind of sit back and say, well, who has the best team? Who is the best traction? So that's why the next rounds become that much more competitive.
Okay. Scott Meadow, let me bring you in. What have you seen of this bottleneck, and how does it affect the startup industry in the U.S.?
Well, I think looking at this from an institutional investor's perspective, they tend to look at things really in 3 ways. Is it a startup? Is it a growth equity project? Or is it near-term liquidity? And they're pretty strict in terms of their definition of growth equity, which means generally that you have a management team that could take it to the promised land, that you have proven profit formula over a number of different examples, and you have referenceable backlog. And so that money has become very scarce. And so because we've had a tremendous amount of success out in the public markets and gaining liquidity, more and more naive funding is flowing in at the early stage. But when it comes to the second stage, the post proof of concept execution stage, you've got a much more sophisticated audience. And
okay, Waverly?
The scarcity that Scott talks about with the later stage funding isn't anything new. Right. I think what's new in all of this is how much further, what Ira was saying, how much further startups can go before they expect that funding. And there's a much higher expectation with the popularity of the lean startup methodology taught by Steve Blank and Eric Ries, that they're now expecting, if I get to this proof of concept, if I get to these customers, then I am ready for VC. And the problem is that the VCs can be very, very selective, very picky about who they actually choose to back. These entrepreneurs have these expectations that are way inflated.
Right, Scott Meadow?
Yeah, and I think there's another problem, and that is that, unfortunately, and Ira can speak to this as well. There's the angel investor puts the majority of their money in the early stage. So then, when something goes to a growth equity stage, when an institutional investor would come in and support the company, you know, many of these companies are defenseless because they don't have any capital in reserve to sort of battle off the institutional investor, who are going for obviously the lowest valuation.
Okay. Ira Weiss?
I think one of the other reasons it's gotten harder to get that next stage of venture funding is there actually has been a very significant contraction in the venture capital community over the last, because of the big downturn. I believe 30% or more of venture funds are gone, and there's been a shift. There's more large funds. The large funds have had a lot of success raising $500 million and up funds, and there are very, very few funds that are in that $100 to $250 million range. And those are really the funds that have historically played more in the Series A and the Series B.
Right, so is that why we've seen these kind of huge investments in a relatively small number of companies rather than more medium-sized investments spread over more companies?
I think that is part of it. Right. There also has been, there are now, the response has been, there are some of these seed funds that have started up over the last 4 or 5 years, many more seed funds that are in the, you know, say sub $100 million range to fill part of that gap. Mm-hmm. But that next gap, you know, maybe late Series A, all of Series B is a very large gap now.
Okay, and talking about you know, the pressures that are on venture capital funding, I referred in the introduction to Bill Gurley and others in Silicon Valley saying there is a bubble. We need to worry, you know, we should be concerned. Companies are taking on too much risk. This is not sustainable. Scott Meadow, what's your view on that?
I agree with him completely. I mean, I remember in '82 when I got into this business, there were 60 disk drive companies started by an industry that had 82 firms and $1 billion under management. So, you know, I also look at the internet period, and, you know, there was massive amounts of money lost, but it was preceded by relatively naive investors support.
So what exactly, so that's a good point, what exactly are the parallels there between the famous tech bubble, late 90s, 2000, and now?
Well, I think there was certainly a reduced level of due diligence that went into any project. I think there was also a...
And you're seeing, just to be clear, you're seeing that now, the same kind of reduced...
I am, right. And I think there was also a problem that the firms with the most prestigious franchises, the benchmarks, et cetera, they were the ones that were able to continue to sustain the funding on the companies that they supported because of their own franchise. Other companies that were just as worthy as the ones that they were supporting couldn't find that money. And that goes back to this problem of a dearth of growth equity.
Okay. Waverly Deutsch, are we in a bubble?
The question of if we're in a bubble is all about sort of risk reward. We're investing about $25 billion of venture capital, and that hasn't been radically different. We had a huge hundreds of billions of dollars in the bubble, and then since then it's ebbed and flowed in that range. The question really is, where do those investors get their returns? Because the concern that I have is that a lot of the investors, particularly in Silicon Valley, are funding a lot of business models without revenue models, right? The idea that free is a business model does not sit well with me as a Chicago Booth professor and a core Midwest investor. And we have too many businesses that are funded with a great amount of money that don't have revenue models.
Is that something that parallels what happened last time around?
I actually think it's almost worse this time around because in the internet bubble, they had revenue models that were based on e-commerce, right? And we had too many sites. The economy couldn't absorb them all. But at least they had revenue models. Now we have these things like WhatsApp, which is all about just distribution. Get on every phone, get in front of every person, and you'll get bought for billions of dollars. So it's where the investors are looking for their returns. When we have companies that go public without self-sustaining revenue models, the investors get to shift the burden from the funds and their limited partners to the Main Street investor and the stock buyer. And you know, it's not a new problem. TiVo went public without having a sustainable revenue model and has never made money in the history of the company. But we're getting more and more of those kinds of companies. Facebook didn't have a self-sustaining revenue model when it went public. Twitter didn't have a self-sustaining revenue model when it went public. So that's where the investment bubble on the VC side or the private equity side can really impact the economy.
Okay, well, speaking of Twitter, we have a question that came in on Twitter. Our Twitter feed at BoothCapIdeas. This is from Ali Aga, who's founder of the app Flowbit. Good question. How can you actually tell if there's a startup bubble or not? And seeing as we're in Chicago, does this affect Chicago startup community as well? Ira Weiss?
How can we tell whether there's a bubble? I don't know that I have a great answer to that. I mean, I see what I see in the market, and I think there are some signs of a bubble at certain funding stages. I think when you see a lot of companies that are not just pre-revenue, but pre-metrics, you know, if you have eyeballs or some external validation that something is working, there are definitely revenue models like freemium models that clearly now work. But there are, I think if you look back over the last 12 to 18 months, there are many more companies that are getting funded at not just a pre-revenue stage, but pre-launch. And you'll see $10 to $15 million go into companies that are pre-launch. And that is what feels similar to me about the prior tech bubble. There are a lot of differences though. I mean, I think the market now, most of the money that goes into these companies goes into companies where there is a verifiable revenue model. It's very clear. I think the WhatsApps of the world are the anomaly now. And mostly you have a lot of really good business-to-business investments that have been made by tech venture funds that have external validated data, revenue models, growing revenue, and a lot of the money goes in for marketing and growth.
Okay. Waverly, do you want to come back on that idea that WhatsApp, the example you gave, is an anomaly, and that it's not typical?
I agree with Ira completely that WhatsApp is an anomaly and it's a disaster for young entrepreneurs because they see it as a possibility. And that's the Mega Millions lottery possibility. You know, 1 in a million, 1 in 2 million companies are going to do what WhatsApp did, but everybody thinks they can achieve it. It's interesting that the Twitter question comes from somebody who's starting an app. The percent of apps on the App Store that get 500,000 downloads is infinitesimally small. So for what happened to WhatsApp, there are thousands and thousands of apps that will burn out and die.
Sure. Scott Meadow, back to Aliaga's question. I am interested in this idea of what the signs are. How could we spot, how do we really know this is a bubble? And also this question of what it means for Chicago, which has a very vibrant startup community, both in the Polsky Center and elsewhere.
We've had a vibrant startup community here in the Midwest before. I mean, during the internet period, there was an enterprise called Divine Interventures, which was a public company, and lots of naive capital flowed into that entity. It did not even have a venture capitalist with 2 deals under their belt. So what I see as a sign of a bubble is more and more naive investors coming in and supporting projects.
At earlier and earlier stages, as Ira was saying.
At earlier and earlier stages, and many of the things that Waverly said as well. So there's no question in my mind that there's going to be an explosion like before. And that's scary because that means clawbacks for the venture capitalists, which means less capital going in. So these post-bubble periods are incredible if you have the money and guts to invest.
Okay.
I just want to comment on Scott keeps talking about naive capital, and I think that that's a really important thing to talk about. Venture capitalists have a lot of experience doing due diligence on their deals, and there are a lot of great angel investors out there. Many are venture capitalists, former venture capitalists, but there are 300,000 plus people in the United States who act as angel investors. And to give you a sense of what Scott's talking about with naive capital, in 2011, angels invested about $25 billion. Venture capitalists invested about $25 billion across all the stages. So what we're talking about is a lot more money coming from individuals who are not necessarily professionally trained, who are investing their own money, so have different fiduciary responsibilities and different goals, coming into the market at these early stages. I think it's a good thing. I think it's great, it supports a lot of innovation, but it does create these unrealistic expectations on the parts of both the entrepreneurs and the angel investors about returns.
Is it? I mean, is this the family members that you referred to earlier?
No, the family members is a whole huge amount of money.
Okay, so who makes up this naive funding?
Well, again, I want to be clear, there are really educated, really experienced angels forming into angel groups, but you are talking about wealthy individuals, whether they're doctors, lawyers, small business owners, who have seen this potential to invest in startups and maybe get rich, who are putting money into deals without really understanding what it takes to advance a company to, cash flow positive, to profitable, to successful. So we're actually not talking about friends and family, because that's hundreds of billions of dollars of money going into businesses. That's the 500,000 companies that are starting, plus companies that are starting every year. I'm just talking about the 66,000 companies that are being backed by angel investors. In fact, in 2013, it was up to 70,000 companies. That's a lot of money coming in. Those people can't be as experienced and as educated as professional angels or venture capitalists.
Ira Weiss?
So if you think about some of the math that Waverly said, think about $25 billion from angels going into companies. That number's been constant for probably the last 8 to 10 years. And the 20 to 25 billion has wavered a bit on the venture side, but because the cost of creating companies have come down so much, what do you have?
They're funding a lot more companies.
You have 10 times as many companies that are started that end up getting funding at the first stage, which I think is how you end up with, part of the crunch. Now, on the bubble side, I personally only started angel and venture investing in 1999, so it's kind of right at the end of the first bubble. I see a lot of differences in terms of who is investing right now. I don't see that many people who are not knowledgeable investing yet. Feels like it's starting to get there, but it hasn't really been there. Most of the money that's going into companies are, more experienced angels who've been doing it for a while because money was tight for a long period of time. So it's probably only the past year or so that's loosened up a little bit. And then the venture money, if you think about that money that's gone in, most of the VCs that have been able to raise are funds that have done extremely well in the past and are pretty sophisticated. So if you think about Mark Andreessen, his view generally has been there's not much of a bubble. If you think about who's pricing some of these rounds, they're being priced by sophisticated investors.
Okay. So everything I hear you say sounds like you don't think there is a bubble.
But I actually do think there are a lot of signs that there are a bubble. And so partially I think it's because these big funds have raised so much money that what happens if you're a big fund and you want to get into a really good deal? Well, the big funds, everyone wants those good deals to be on their docket of deals, and so they're willing to pay, I wouldn't say whatever it takes, but valuations that are not based on external metrics. And if you think about the math, let's take Andreessen Horowitz. Andreessen Horowitz, they just raised another $1.5 billion fund. In 2012, they raised a $1.5 billion fund. In order for them to move the needle on anything interesting, they need to invest $30 to $50 million in something. If they need to invest $30 to $50 million and they see something interesting, even if that company is at a revenue run rate of 2 to 5 million, they need to invest 50 million. So how do you then price the company? Historically, if you take the metrics, you would say, well, they would buy the whole company for 50 million. But you can't buy the whole company because you want the entrepreneur to have appropriate incentives. So instead, they price it at $100 million. Or they buy some of the investors out. $100 million, they'll invest their 50, and the post money is $150 million. And then when you do the calculations, which are essentially value to revenue, it's off the charts. It could be 30 times revenue, 50 times revenue, 100 times revenue. But a lot of it's driven by the fact that they need to put really big checks to work. And so that is the part of it that feels like a bubble to me. At the later stages, in some ways it's good for some early investors, but at the later stages, there is a lot of big funds that are pricing things in ways that are not based on economic fundamentals.
Okay. Scott Meadow, so if there's some agreement that there's some kind of a bubble, what follows a bubble is a correction. You talked a little bit about what that might mean. How soon do you expect that to happen? Because people are saying as soon as the next 9 months.
How soon do I think the bubble?
How soon do you think the bubble could burst, or at least start contracting? And what will it mean? Tell us a bit more about what that might mean.
Well, I don't think that's predictable, Hal. I mean, I recall
it's a good University of Chicago response.
I recall, like in the 1999-2000 period. I mean, I was with a very prominent firm, and we were making investments in internet startups 2 weeks before the classic inflection point. So I think things.
Were you aware at that time that there was a bubble?
I actually resigned from the firm and joined the faculty here around that period because there was no analysis.
So your timing is impeccable.
Well, my timing has been good from time to time. I'm sorry, but your question.
But I was trying to press you on how soon we could see a correction and what it might mean.
Yeah, well, and then that correction really is a function of what's going on in the public markets and so forth. But what generally happens in the venture business is everybody's a lemming. So there'll be a general pullback in support, which means more companies going under, which further fuels the bubble. And there's a lot of internal problems that happen with these funds. For example, if you have a process where, for some reason, the capital account of the LP falls behind the capital account of the GP, then the GP has to write.
Just explain those terms.
A general partner is the traditional venture capitalist, and LPs would be Notre Dame or somebody that would be investing. Well, the GPs have to write big checks. So if you get a correspondence on Tuesday saying you owe $600,000 personally, please pay it by the following Tuesday, your mind is probably going to be more on that problem than it is on the portfolio. So those factors tend to sort of stagnate the industry for a period of time.
Okay. Ira Weiss?
I also do think there are signs of a bubble, but I think the way it may unfold feels very different than what happened in the early, with the last tech bubble. What happened with the last tech bubble is you had a lot of companies that were going public and had no revenue. And that public market fueled a lot of what happened in the private market, and that is not something that we have now. Now, in order to go public, I think the average revenue you have to have right now is about $55 million a year, which has gone down a bit. So it was about $100 million a year, but it is nothing like what it was back then. And so how would you see a pullback and how would you see a bubble unfolding? Well, I think you could see a smaller correction, maybe a 25 or 30% correction in the public markets for tech companies, which is not, maybe a partial bursting. And that could impact some of the later stage fundings that are going on. And the later stage funding really feels like right now where there's a lot of money in the market, and that's what's, you have public markets that are open. If the public markets shut a little bit, then the later stage funding markets will shut a little bit, and it will cascade like that. What happened with the last tech bubble bursting is you had the entire market completely burst because companies would go public so quickly. We don't have anything. We have very little of that today. Even Twitter, think about it, in some ways companies are going public much later. Pinterest, which has, the last market valuation was private market was $5 billion. It doesn't want to go public until it has a clear revenue model, just like Twitter. So you have companies in those later stages waiting more and more to go public. So I just don't see a big burst like last time.
So a correction, but not a disaster. Waverly, what's your view about how this will play out?
But even a correction has ripple effects to the average person, because when Scott talks about Notre Dame being a limited partner and investor in a fund, there are lots and lots of companies that have parts of their pension funds, parts of their investment portfolios, right? Lots and lots of companies have money in this tech game. So it won't be the disastrous tech crash, but earnings on a pension fund might go down if a venture fund goes under. It will have a ripple effect to the broader market. And we're also in a very high stock market in general right now. So as far as if there were to be some kind of a correction, as Ira talks about, investor confidence could be hit with the Dow as high as it is. You could see a ripple effect across the stock market as well, just like we saw in 2007, 2008 timeframe.
Right.
And the investor confidence plays out the way you would think. There's a flight to quality. And the franchise firms like Kleiner Perkins and some of the others that Ira was talking about before, they can fund as a result of that franchise. So it's not only do they have their own capital to support their projects forever, but they also are able to bring in people from all over the country who just want to be investing with them. And the problem is that shrinks the number of funds, fewer and fewer and fewer, which I think, hurts entrepreneurship in general.
Okay, Ira Weiss, very briefly.
So I actually think there's some evidence that if there is a bubble, that it's going to take a while for it to burst or even correct, because actually if you think about the pension funds, most of them scaled back their allocation to venture funds significantly. Right. CalPERS scaled it back from, which is one of the biggest, from 6% down to 1%. And a lot of the other pension funds have not.
Did they do that because they saw this coming, or?
No, they did this before. They did this during the big downturn, but they haven't. I mean, they have not adjusted upwards, and so they've scaled back a lot. And it's an asset class for pension funds. I've seen it in the market. They're just dipping their toe in it again now and putting a few more dollars in. If you look at the numbers reported by Thomson Reuters National Venture Capital Association, the first half of this year venture funds raised $16.5 billion. Last year they raised about $18 billion. So it's actually accelerating. There's more money coming into venture capital now than there was. Okay,
I just want to turn to Waverly, though, for one final thought, which is you coach entrepreneurs, startups. What are you telling them right now?
So what I want to tell all of those entrepreneurs is that idealized path where someone else is funding your business is a long shot. In general, it's a long shot. And what you need to do is create a business where you can see a path to your own revenue. Research that I've done on the Kaufman Firm Study database, which followed small company startups from 2006 to 2011, indicates that if your company doesn't learn how to sell and generate your own revenue in the first 2 to 3 years, it probably never will. There are companies in that database that went out of business after 5 years, after 6 years, after 7 years, and their patterns show that they never learned how to sell. It wasn't like they went up and came down. They just never learned how to sell. If your company isn't generating revenue in the first 2 to 3 years, and if you can't see a path to cash flow positive, then you're hoping to be rescued by outside money. Don't do it. Okay. Found a business that has a revenue model.
Okay, well, on that note, like many a failed startup, our time is up. My thanks to our panel, Scott Meadow, Waverly Deutsch, and Ira Weiss. For more research, analysis, and commentary, visit us online at chicagobooth.edu/capideas, and join us again next time for another Big Question. Goodbye.